Hey everyone. Today, well, I've talked to Danny before. If you see my recordings, maybe a couple of years down the line, you might see it. But today, with the start of the new podcast, this is why I wanted to interview Danny again, because he's one of the few guys I know who's big in the, hotel syndication world. So I wanted to share, let people understand what that is, and also, if they wanted to obviously invest or, talk to Danny, they can go reach out to him. With that being said, I'm going to let Danny kind of do a brief intro, Danny, because people who haven't, I guess, listened to you before, could you give your brief history and obviously, how you got into the hotel syndication business?
Absolutely. First off, thanks a lot, Rajiv, for allowing me to come on here. It's a pleasure. Every time we get together, we have a good time. So it's a pleasure being able to be on your show. And yeah, so my name is Danny Frye. I grew up in Atlanta, the son of a police officer and a post officer, postmaster. So and then joined the military. Spent 20 years as a combat engineer in the Army and into special operations, and then jumped right out. And just like everybody, a lot of other people in the military kind of get forced into real estate investing. So you go buy your first house, and then 9 months later, they tell you, "Hey, man, you're going to Hawaii, or Texas, and you can't sell your house, so you have to rent it." And for me, I had a good experience. So, I started, after about 4 or 5 years, I started seeing returns. I'm like, wow, man, my rent's going up and my mortgage is staying the same. And now I'm putting money in my pocket. And after 5 years, my house had been paid off, paid down substantially.
Mhm.
And only lived in it for about 9 months. So, I caught the bug, bought a 4 unit complex. And then when I got out of the military, I knew I was getting right into real estate. I started flipping a few houses and, doing the single family thing. And yeah, I just felt like there was a more efficient way. And so I met my partners with Tempest 22, and I met my operating partner with David Stahl. He owns a hotel management company, and it clicked for us, right? We can tell you about syndications in a little bit, but what clicked for us is the system, right? So
Yep. Mhm.
people, they'll look for deals and look for deals and look for deals, and a lot of times, deals are hard to find for some people.
Mhm.
And once we found an operating partner
Mhm.
like David, we didn't have to look for deals anymore because he already had them. People brought them to him. When you got a good operator, people bring you deals.
Right.
And so we don't even look at him. He brings the one that he thinks is going to make a lot of money, and he knows that space,
Mhm.
you know, quite a bit better than we do. But we understand how investments work. We know how to do a design so that everybody wins. And so we just come from that team of teams mentality. Put together a good team, somebody that operates, somebody that brings money, somebody that organizes and structures, somebody that manages and supervises, and somebody that's making sure that we stay in compliance with the SEC.
Mhm. Got you. Awesome. Well, let's get into a little bit of, people who are not familiar with hotel syndication. Um, or, people who are not investors probably know what syndication even mean, right? But let's assume they know syndication. Syndication is obviously, a bunch of people investing together with, few key people who are running and managing all the asset and all that stuff. So in the, hotel, like you said, key is the operator or who knows how to operate. Kind of get into that. Like, why is that a key, and why is that the main difference between any other syndication or any other, it doesn't matter, multifamily or hotel, how somebody knows how to, I guess, make it profitable is more important than anything else.
Yeah, absolutely. So we look at it from a business standpoint. One thing the three partners in Tempest 22 are all veterans, and throughout active duty, we're able to make a substantial revenue and build an asset base, and even businesses. One of our partners, Octavio, he was able to build 10 businesses, all profitable without his day-to-day operations in it, while on active duty, serving in a high op tempo environment that really demanded his time, like the 82nd Airborne Division.
Mm.
And Adeep was in the Navy, so he'd spent time out at out at sea, and he's building a real estate empire. But the thing is we all had to put a lot of time, energy, and commitment into researching and reading and learning everything that we could, and then meeting people and networking and just absorbing everything that we could. And then we took our risks. We took risks, and the hardest part is doing the first step. Is making that first step, doing a commitment, executing. And you can learn as much as you want in theory. You can read all the books, you can go to college, you can go to school, but until you're only going to get about 20% of the information that you need.
Right.
Everything else, you have to do it. You just got to take a step. So what we found is that a lot of our brothers and sisters in the military, and our family, our close family and friends, we're looking at us like this is some big secret on what we're doing, and it really wasn't. It was just while they were watching football games and going to ball games and whatever, we were looking at real estate, and learning that, so we kind of replaced our hobby with real estate versus going to ball games and stuff. So but it gave us a lot of freedom, financial. When you don't have to rely so much on your active income, your primary income, it creates a lot of freedom, right? A lot of freedom to choose what you want to do, a lot of freedom to be able to, say no to certain things or say yes to other things. And, you find you can help a lot of people, when you have some resources. So, we put that together and, looked at all our brothers and sisters in the military and thought, man, I wish they could come with us. Like that's why we ended up jumping into hotels. It wasn't specifically hotels. We started looking into larger commercial projects, and because we wanted to be able to say, hey, look, we took all this risk early on to learn all these lessons. We studied all this stuff. Why don't you focus on being a soldier or a lawyer or a doctor or a gas station attendant or a clerk or whatever it is, a police officer, whatever it is that you do, you can focus on that. Right now you're probably putting money in, in stock markets or, whatever you're, mutual funds like everybody tells you to do, or, you're using your 401k or your IRA and you're, putting it into some kind of designated mutual fund that you have no idea on what it's doing, what the fees are. And the growth is marginal at best. Well, why don't you leverage, some guys like us, that went and made mistakes early on. So we knew what not to do now. That where we were able to, put our money and time and energy into learning the pitfalls and the mistakes. And then, the same thing with our hotel operator. If you find somebody that wants to invest in a hotel, the first thing they think is, how am I going to run that? And for us, we were like, who's going to run it? Right. And so once we, flipped our mindset to who was going to do the work, not the work, per se, but who was going to do the day-to-day work in that hotel. Logically, it made sense to find somebody that does it all the time. And that's what they love doing. And, it just so happened that we met a gentleman by the name of David Stahl, and he's a third-generation hoteler, second-generation Cornell graduate. And they'll have a fourth generation coming on board in the next few years. And it's going to continue. They're a hotel family, so legacy is very important to them. And, so we find people like that want to do those types of assets, and we know how to design a deal, within the rules and regulations and guidelines with the Securities and Exchange Commission.
Gotcha. Awesome. Well, you kind of, a couple of things I wanted to get into. There was a shift, seems like a couple of shifts. One was obviously, accidentally getting into real estate, but then the key word you said was, while people were spending time on watching, football, whatever, all those activities, you guys were spending time on doing this. So what was that shift for you? Like, hey, this time spent on this is much more productive than me watching football, whatever, right? All those things. So what was that shift like? And the second was, you guys figured out like, hey, instead of trying to do it ourselves, we just find the person who can do it on hotels. And you guys went and found, right? Both where it seems like shift. I'm guessing it came from their real estate experience to do that, but I'll let you explain that.
Yeah, I think everybody has a journey, a financial journey, right? Some people just don't realize it, right? Some people do, and they just don't realize where it's going to end up. They're not going with intention. And there is, like you said, a shift. That's a great word. There is a shift, a paradigm shift at some point to where you start seeing your money work for you, right? Where you work so hard your whole life for your money. And then, if once you get that paradigm shift and you see that your money starts working for you, and it changes that dynamic, it puts power back into your hands, authority, freedom, because you have something that's working for you, right? That you work so hard for. Well, I mean, if you do it, if you employ those funds, I call it your, the excess or working capital. You deploy that little bit of excess that you have over time, it's going to grow. And then, over more time, it's going to grow into something that's going to replace the need for you to work. Well, if you love doing what you do, that's awesome. Now you have a lot of freedom, a lot of flexibility, right? That you can do whatever those are. Some people, hate their job, but they're not putting any money away, so they're not doing anything to change it. So once we've figured out the mentality shift that, hey, our excess needs to go into working for us, and then we can use that, what comes from that excess, and now we can bless other people with it, but you can't really, if you're living paycheck to paycheck, you can't bless anybody with your money. You don't have any funds. You're still trying to figure out how you're going to put food on the table or pay for your mortgage or put gas in the car, and then you have an inflation that goes up, 20% for groceries over the past 2 years or something like that. That wasn't in the budget, man.
Right.
Now you got to figure out what you're going to cut out. Well, if if you change your mindset, hey, I have to put some money away every single month, into something that's going to grow. Right. It starts small. You're not going to go buy a hotel or an apartment building, with $100, but you put that $100 into something that's going to, it's going to accumulate and then have a little bit of growth. After some time, now you can do something with $5,000. You can do something with $10,000, right? You got to get it up to that point, and you're never going to get it up there without starting with, $20.
Yeah.
$10. So we had that shift. And then once our money started making money for us, it totally changed what we wanted to spend money on.
Awesome. Yeah, no, same thing. Like going back into the hotels, you kind of figured out like you need to find somebody. And whatever reason you chose hotels is that one of the things I guess you guys figured out is, hey, we need to find a good operator that can run this thing for us and make it profitable, right? Was that the basic lessons you learned from your real estate that kind of shifted into, okay, this is the asset class we're going to go after. All we need to do is find a good operator?
Actually, it wasn't necessarily specifically for hotels. We solved that problem. We created a model, right, that focused on building relationships with an operating partner. Okay. Now, that you can use that same methodology in any sector. Right. So if I wanted to do multifamily, I just need to find somebody that understands how to run a multifamily operation. Right. Not just the manager, not just the property management, but understands how to run the business of a multifamily operation. Right. And you partner with people like that, because they understand the industry, right, at the ground level. Our company, we need to understand the industry at the macro level, right, and how to employ, let's say that, whatever that property management company isn't there, we need to know, what makes it successful, what makes it not. We need to be able to identify where anomalies are so that we, you don't want to be a sucker, right? So, you want to invest in things that you don't know anything about. So, we do our research and we get into it. and then we partner with people that we have a high degree of confidence. I use the term trust, but I'm starting to remove that word from my vocabulary because, people's trust and confidence mean virtually the exact same thing. Okay. But if I say trust, people have a preconceived notion that trust means blind faith, right? And it doesn't. So confidence, especially if you start talking about statistics, right? There's a degree of confidence, right? That, I have a low risk, high degree of confidence. Well, that's trust. Okay. Well, if for whatever reason the degree of confidence goes down, the risk goes up, my trust goes down, right? So, we find people that we can, that share our values, and we're people centric. It's vitally important for us to bring opportunities to regular people, right? And because every deal we have a methodology that everything that we're going to find, it's to our base partners, to our limited partners or passive investors. We target 18 to 24% annualized rate of return. And if it doesn't meet that, then we don't do it. So the money factor is never really, it's not even really a motivation, because we're going to find deals all day long that'll do that. And if we can't, we'll adjust our operations. But right now we're not having a problem finding that. So, money is, now we run a tight ship, we try to keep it as efficiently as possible, especially in an economic downturn. You really got to be really, you have to narrow down the efficiency, right? It starts highlighting all of the inefficiencies in the down market, which is, people look at it as bad. We look at it as a good thing, right? You want to highlight, your shortcomings and then become more efficient in those areas. So it's been good. And, but if we're only giving it this opportunity to wealthy people, we're not really serving anybody, So, there's a million companies out there that are offering this kind of deal to, to wealthy people. And there's not a lot of people, that have, figured out ways on how you can offer it to the masses. And that's what's really important to us.
Awesome. When you say, not so wealthy, are you talking about, less than 100K, 50K? What level are you trying to cater to?
Yeah. So that's a very good question. So there's a term called an accredited investor.
Right.
Okay. And for an accredited investor, and actually it's been in the news a lot lately, and you really need to take a look at some of the articles that are being pushed out from, the SEC. Is the discussion for the last few years is that they were going to adjust the definitions of what an accredited investor is.
Yes. There's
a lot of people out there that don't realize they're an accredited investor. If you make $200,000 a year, or $300,000 as a family, you're an accredited investor. If you have a net worth of $1 million or more, not counting your primary residence, you're an accredited investor, right? There's plenty of other definitions that, it's like, hey, all you have to do is qualify for one of these definitions. But those are the two primary. It's either income-based or asset-based. So when those definitions were issued, I believe it was in the 80s or early 90s, they set it at $1 million net worth, not counting your primary residence, and $200,000. I think it was 150, but it's gone up to 200,000. It was less than 2%. It's like 1.8, 1.5% of the population or households in America were accredited, right? So, the SEC says, hey, look, if you're an accredited investor, you can assume the risk. Like, we trust you to assume the risk. So it's really there to protect people from unscrupulous operators and investors that are putting private deals together that aren't governed by the Securities and Exchange Commission. Is designed to really protect them. But the new, but the definitions, there's a lot of people who've got into investing, have developed a certain level of sophistication, right? And, there's been a lot of discussion over the last 5 or 6 years about enhancing that definition to really make it more inclusive to more people. right? But they just reached, put out guidance on what their recommendations for the change is, and it went the other direction, right? So they want to adjust it for inflation, right? They want to make it to basically you got to have a net worth of $4 million, $4+ million, and an income of like 900 and something $1,000. And it's like, man, all of these opportunities, the private investments, private equity outperform the S&P 500 1 to 5% every year. Doesn't matter, right? And so your best investment opportunities are the ones that haven't been crushed by all the legalities and things, and the bureaucratic red tape, that you're going to find in a public stock market, right? So yeah, it's for the wealthy, so when you say wealthy, it's the accredited investors. Well, right now, it's 18.5% of households in America qualify as accredited, right? Up from 1.5%. Well, with the new change, they want to bring it back down to about 1.8%. So they want to limit, they want to limit what you can invest. Who can invest in these things? Right. But we've seen 20% of people. I mean, $1 million in net worth, not counting primary residence, is a lot, man. That's a lot of assets. So, for us, we can offer, you can structure a syndication under a Reg D, under a 506C, allows accredited investors only, right? You'll see those, sometimes advertised on a radio station or a television, or you're probably even seeing them on your Facebook ads. I mean, you've probably seen ours on the Facebook, right? But you can also structure as a 506B. It allows non-accredited investors, right? So what that's still kind of limiting because you can only have 35 and you still can't advertise and market. So it has to be people that right? You have to have a direct. So it's put all these restrictions on allowing sophisticated investors to come into a deal like that. And it puts us to a position to where, I have to take a high amount. So if I got $1 million raise, which really isn't that much money when it comes to, acquiring, to commercial real estate, I've got to divide that by 35, and it's still going to be a substantial, amount of money for that, non-accredited sophisticated investor. You're still talking 25, 30, 50. Well, there's another regulation crowdfunding, or Reg A+, and that allows us to open it up to non-accredited investors, as many as we want. We're allowed to advertise through testing and water phase. And, there's a couple of different rules that are associated with that. But we can take as low as, $1,500. Just depends on what that is. And so now we're starting to implement those types of operations into our strategy moving forward. And the company's scaling substantially as well. So, we've got hotels pretty much ironed out, right? Like that whole process. We know what to look for. We know what to find. So now we're making other relationships in different spaces, like, dental services and trailer parks and shopping plazas, nail salons, gas stations. So we're having these discussions. And another thing is that, we're looking at other sharp people that have been wanting to do, sponsor and host their own deals, or they're having problems with deal flow, or maybe they had they got a lot of momentum, but they're having some trouble with the infrastructure, or, the money, they got a small deal and they just don't have the money. So we started looking for other smaller, not smaller per se, but, other general partners to come along with us. So not only are we looking for, do we want investors to come on board? We want to educate people on personal finance. I mean, that's really what it boils down to, and helping them break some financial bondage. And then we want to find other people that think like us, and that really have a passion for helping people out, that want to partner with us on some of our deals. And we've got that, because of the years of going through and putting our critical infrastructure together within the company and learning the mistakes and ironing out the details, we've built a pretty good system, that's able to, just kind of plug and play. And we've got a really good oversight.
Awesome. Well, that's a lot of information. So as you can see, I mean, whether you got a lot of money to invest or a little bit of money, as Danny kind of, maybe listen to that part again. So where you can potentially invest or be involved. I mean, he's also talking about mergers and acquisitions essentially there, which is another big thing going on. Like he said, it's critical to have systems in place that are really good, that somebody already knows. So joining forces with those kind of people will help you grow and all. So anyway, like I say, I'll be sharing Danny's information. So any of those kind of hit you, go reach out to him. Like he said, he also loves to educate people. So maybe part of the process is you learn how to invest. So go reach out to Danny about that. All right, Danny, we covered a lot of information. So now we'll get to my last two favorite questions always. I think you shared this before, but maybe it's different now. So seems like there's some inspiration I see there in the last part of the share, but what inspires you to get up and do what you do every day these days now?
Yeah, so it's a lot. It's a lot of things, but it boils down to one.
Mm-hmm.
Growing up, my parents were divorced when I was very young,
mm-hmm.
and just like a lot of parents, a lot of kids' parents around that age, right?
Mm-hmm.
And my dad made pretty decent money, but he wasn't like a upper middle class guy. He was a postmaster for a small post office,
Mm-hmm.
And then my mom at that time, had been a stay-at-home mom, and then when they split, she's got kids and had to figure life out. Man, she worked 3 full-time jobs when I was like 8, 9 years old, and my brothers were like 4 and 5, and she lived with my aunt, who was a nurse, and she had, she was, a single mom, had, other, 2 little girls that were the same age as my 2 little brothers,
Mm-hmm.
all lived in the same house together, and they worked all the time. It was two job. Mom was working 2 full-time jobs and going through the police academy. And my Aunt Sherry was working every shift she could pick up because she'd basically got out of school and she had student debt, stuff like that. And we all lived in the same small little house, 1 car. And we were one minor catastrophe away from being homeless, my whole life. And I think a lot of people live that way. I saw a video, I know we're kind of probably short on time, but saw a video the other day, really resonated with me. It was all over the news. It was a TikTok video of a woman, and she was a registered nurse, and she's crying, right? Because it's Monday, she got paid Friday, and they put gas in the car, they paid the mortgage, and they put some groceries in, and they had $200 left for the week. And it's 2-income family. She's a registered nurse. He doesn't make quite as much money, but pretty decent money. They didn't live like a really extravagant lifestyle. It's small, 3-bedroom, 1-bathroom ranch style house, 1,400 square feet in a metropolitan area, and they're virtually broke, and I hear 2 things there. One is desperation, right, of not having any extra. And 2, I hear $200 extra a week this week. If you add that up to 4, that's $1,600. If you put half of that away by the end of the year, you're gonna have $4,800, and you can do something magical with that, right? And you do that for a couple of years, and you've broken that, that slavery, the bonds to financial slavery, and so that's why we do it.
Awesome. Yeah, no, that's a great inspiration indeed. All right, last but not the least, one tip you can share. I don't remember the last one you shared. Maybe it'll be a new one, maybe it'll be the same one. But what's the one tip you can share for either personal or professional that will help others?
Sure. Treat your finances. Not like a budget, like they tell you personal finances. Treat it like a business. Business has to make profit to be successful, right? So at the end of every month, if your personal life has profit, then you have working capital to grow your family business, right? So I would just change your mindset a little bit. Don't expend everything. Don't, you've got good debt and bad debt. Your credit is so valuable. Don't let, don't get, if the debt isn't making money for you, it's bad debt, right? So look at eliminating all bad debt, because that will give you about 80% more resources than your liquid capital.
Awesome. That's a great tip. That's a better way to put it. Awesome. Thanks again, Danny. All right. like I said, I'll be sharing Danny's information. And if you're watching the YouTube channel or podcast, please subscribe. It's called Mind Shift to Your Health and Wealth. You got the health tips here with Danny. So reach out to him if you like what you heard. So thanks again, Danny.
Yeah, thank you so much, Raju.